Let's see, who are we missing? Oscar. Okay. I don't know if you all noticed, but I put up the first quiz for this class yesterday. I don't know if anybody's looked at it yet.
Yeah.
So I drew up a test bank. It covers the first part of the PowerPoint slides from from week 5. And when you take it, it's going to randomly select 20 questions from that test bank. And then you can answer them one at a time. So it should work. I had a student do the quiz for government accounting already, and it worked for him, and he got an A on it. So I'm trying to remember how far we got into the Unit 5 PowerPoint. Or if we finished it and started Unit 6. I don't remember talking about the tax shelters. Do you remember talking about that?
I don't, but I'm not sure.
About the what? What did you say?
Tax shelters.
I don't remember that one.
How about was the last thing we talked about before break Scrooge then, maybe?
Yeah, we talked about Scrooge. Yeah.
Yeah, I remember we did because we looked at the video.
Yeah.
Interviewed on 60 Minutes.
Yeah, healthcare South, yeah.
But after that is a section on the AICP principles of professional conduct. And I don't remember going over that in class. So that's where I'm going to pick up now. I guess I need to hit share screen before I open it. Okay, are you all looking now at a slide that says Learning Objective 9, AICPA Principles of Professional Conduct?
Yep.
Okay, I want to make sure that it was showing you what it was supposed to be showing. So this is right after we talked about Scrooge. And the AICPA has, let's refresh your memory. What is the AICPA? Not what do the initials stand for. I think everybody knows it's the American Institute of Certified Public Accountants, but what do they do? Anybody remember that?
Regulate public or like they set the standards for the CPA test and stuff.
They write the CPA exam and they lobby the state government boards of accountancy to try to influence their standards for licensure. Each state government sets its own standards for licensure, but the AICPA has a lot of influence in that, because it would be like a state government trying to license medical doctors and not listening to the American Medical Association. That wouldn't make any sense. And before the PCAOB, the AICPA set the auditing standards. And their auditing standards are still required for audits that are not for SEC registrants. And they have a long code of ethics that they call the Principles of Professional Conduct. So that's what we're going to be looking at here. Starting off with the integrity principle that says it should be used when the accounting rules are unclear or there's a difference of opinion with an employer or client on an accounting issue, or if there's conflicts between the interests of stakeholder groups. International Federation of Accounting, what's the C for? It's an international group that explicitly recognizes compliance with relevant laws and regulations and avoiding acts that bring discredit on the profession. So the fundamental principles that the AICPA says are required for a professional conduct are integrity, objectivity, professional competence, due care, confidentiality, and professional behavior. So if you think about it, if you had a CPA firm auditing your company and they didn't follow those principles, it would cause a real problem. So Rule 102, integrity and objectivity. The CPA must have integrity and must be able to be objective in judgments. Not sure how you can measure integrity other than if they did something that was bad, then you'd know perhaps they lacked it. The AICPA emphasizes that these have to reinforce the CPA's independence. Rule 201 requires due care because the CPA must perform services competently, accurately, and completely, and at a high quality. Prima facie evidence of due care is demonstrated when the CPA documents followed GAS and the technical standards of GAAP. So you might not have seen the phrase prima facie before. It comes from Latin. It's a legal term. Prime, you might be able to guess the meaning. It means first. Facie, on the face. So what they mean by prima facie evidence is that if you have this, all you have to do is show that it exists. On the face of it, it proves it. You don't need to dig any deeper. So if you follow the standards of GAS and you've documented it on paper or in your computer system, and you've documented that you followed all the standards of GAAP, then that proves that you have due care. Rule 203 requires CPAs to ensure that the financial statements and disclosures are in conformity with GAAP before rendering an opinion, which that's a strange requirement because their opinion is whether or not it's in conformity with GAAP. So if you followed that sentence literally, they would never be able to give an opinion unless the financial statements were fair. But sometimes they have to give an opinion, like a disclaimer or oh, I'm having a mental block for the opinion that says that it's not fair. What's that phrase? Adverse opinion. So anyway, CPAs, regardless of whether they're internal or external accountants, are required to follow GAAP. Confidentiality. CPAs have an obligation not to divulge client information unless the client agrees. The auditor is going to be looking at all sorts of documents when they do the audit, some of which might be a confidential statement. They might be looking at employee records and they find out that a certain employee is about to be terminated. They would not have the right to tell that employee. That's not their call. Also, they would have access to all of the company's plans on what they're going to be doing in the future. And if they release that information, it could really harm the client's competitiveness. But sometimes they have to disclose confidential information. If they've been issued a summons or a subpoena, if they have a legal requirement to disclose it, if it's required by a peer review of the firm, and it's necessary for the CPA's legal defense. So if there's a trial and the court says you have to provide information, then you have to provide the information. If you're being sued, you can use the information in your defense. Peer review, the PCAOB has a system in place where CPA firms assess the quality of the audits done by other CPA firms. PCAOB doesn't actually do it themselves. External whistleblowing. An external CPA can't normally blow the whistle without violating confidentiality. But if they discover a crime has been committed that would materially impact the financial statements, they have to talk to their own legal counsel and to the client's audit committee. If they tell the audit committee that they found a crime, the audit committee has 24 hours to report it to the board of directors. And the board of directors has 24 hours to report it to the SEC. And then if the SEC is not informed within 48 hours, the audit firm they've got to resign the engagement because they know the client's obstructing information. Internal whistleblowing. So what we're talking previously is external, telling authorities outside the company, and you are an external accountant. You're not working inside the company, but accountants that are working inside a company, not auditors, have to blow the whistle if they find out a fraud is going on. Contingent fees, I think we talked about that before. Many lawyers advertise on TV. A CPA firm they advertise on TV that the case will be free unless the case is won. And so that's a contingent fee. CPA firms can't do that because it makes them lose their independence. Because if they promise to get paid on this contingency basis, then the more money they save the client, the more they get paid. And so they would have a temptation to kind of cut corners and find things that maybe not actually all that legal. Acts discreditable. A member shall not commit an act that is discreditable to the profession. Examples, they have to return records belonging to the client when asked. They can't discriminate against or harass employees. They have to follow the standards for government audits. Can't be negligent when preparing financial statements or records, follow government regulations when auditing. They may not disclose the questions or answers to the CPA exam, and they have to file their tax returns and pay their taxes. Advertising is allowed as long as it's not false, misleading, or deceptive. They can't imply in an ad that they can influence official government organizations. And you can't use coercion or harassment to solicit business. I'm trying to remember the legal term where that's extortion. No commissions from audit clients. They can get referral fees for recommending products or services, except in California. A CPA firm has to be organized according to state laws and regulations. So tax services, only some tax services can be provided to your audit client. And we talked about that before, that it's not going to be an impairment of your independence if all you do for a client is fill in the boxes on their tax return. But once you start giving them advice about how to save money on taxes or to get tax breaks or anything, then you're no longer objective and independent. But that's required, integrity and objectivity. Due care, which is reasonable. You don't want someone preparing a sloppy tax return for you. Let's see, they have confidentiality. Now, contingent fees are allowed by Rule 302. I'm not sure that that's a good idea because of what we were saying before. They might be tempted to get tax breaks for a tax customer that are not exactly completely kosher. Tax compliance services, preparing, signing, filing, transmitting a tax return to the IRS. CPAs can do that for their audit clients as long as management reviews and approves the tax return and management signs the tax return. 7 statements for tax services. The AICPA said that independence is not really an issue for a tax practitioner. Auditors are supposed to be objective and independent, but tax practitioners should try to help their clients avoid unnecessary taxation. On the other hand, they should advocate only reasonable tax positions that benefit their clients. They can't recommend a tax position that minimizes the client's taxes unless it has what's called the realistic possibility of success. And that means that if they followed this strategy and the IRS audits the return, they're more likely than not to say that this was an okay strategy that didn't violate IRS regulations. And although they have to advocate the client's interests, they also have to comply with the tax code. Tax shelter, tax avoidance, tax evasion. Tax avoidance means finding a way to pay as little tax as is legally possible. Tax evasion means that you're not paying taxes that are required. A tax shelter is a legal investment that reduces or eliminates the investor's tax burden. A simple example is investing in tax-free municipal bonds. Practice can be abused. Arthur Andersen had aggressively marketed tax shelters that the government found abusive. KPMG had to pay the IRS $456 million to avoid criminal prosecution for selling fraudulent tax shelters. BDO was prosecuted for helping clients evade 1.3 billion in income taxes. PCAOB says audit clients may not also be given certain types of tax services because it jeopardizes the auditor's independence. An auditor cannot be providing tax services to the client's management. And if a CPA firm is going to do taxes for the audit client, the client's audit committee has to give their approval. And that finishes this unit. So what I'll be doing is preparing a quiz that covers the latter half of Unit 5. I don't know how fast I'm going to be able to get that loaded up. And so on Monday, then, we're going to start by taking a look at Unit 6.
Is our quiz able to be taken now, or do we have to wait till a certain date?
You can take it now. I would suggest studying a little first.
Is it timed or anything like that?
Yeah, 20 questions. You've got 40 minutes to do it. And usually when it's a 20-minute or 20-question multiple choice quiz, most students finish in about 25, 30 minutes. So that should be not a time problem.
When did you say we need to have that in by?
Let me open up Canvas. And show you what I did. Huh. I don't think it saved what I did. Okay, let me show you this one. Okay, so you are looking at the quiz assignment here. And there's sort of two deadlines. It says it's available until April 24th. And that means if you don't take it by that date, you can't take it at all. I've given, however, a due date of April 3rd, which really, that's still procrastinating an awfully long time because it's material that we've already gone over before the break. And so you should try to do that in the next few days. So there's no late penalty if you take it after that due date. The point is, however, that the longer you wait, the more these assignments are going to pile up, and then you won't have time to study for them. So really, once it's posted and ready to go, you should try to take it within a few days. Does that make sense? And Christy asked if the quizzes are meant to be closed notes. Yes, they are. And that's one thing about the time limit. If you've got 20 questions and you have not yet studied for them, you're going to have a really hard time looking up answers and still finishing in the 40 minutes. On the other hand, if you did study for it, you should be able to finish in about 25 minutes. Other questions about it? I saw several assignments had been submitted on Canvas, but I haven't had time to go look at them and record scores yet. I don't know about y'all, but for me, having to get all this stuff and put it onto the internet, I'm working until 7 o'clock every night and I'm falling farther and farther behind. So anyway, I get done what I can. So if there's no other questions, then what I would like to have you do is be prepared on Monday for us to go over the PowerPoint for week 6 during class, and then work on the written assignments that were already posted on Canvas as part of the original syllabus, and then try to get the quiz A done if you've got time over the weekend. Any other questions? All right, then it's nice seeing you all, and I'll talk to you again on Monday.